Welcome everyone. Today we are going to take a deep dive into some of the best volume indicators you can use for intraday trading. These tools are incredibly powerful for finding trends, breakouts, and reversals as they happen in real time. By the time we finish today, you will have a good understanding of which volume indicators can help give you an edge when trading in fast-paced markets. So stick around, you will not want to miss this. Imagine you could see at a glance whether the majority of traders are backing a move or if it is likely to falter. That is exactly what on balance volume or on balance volume helps you do. On balance volume adds the volume on up days and subtracts it on down days, creating a constantly changing cumulative number. This allows you to determine if the current price trend is being supported by more buyers or more sellers. In the fast-paced world of intraday trading, knowing whether buyers or sellers are in control can make all the difference. If on-balance volume is increasing while the price is also rising, it means the uptrend is strong and supported by real buying interest. Conversely, if on-balance volume is decreasing along with the price, it indicates that the downtrend is still strong and has the support of sellers. This type of insight is vital for understanding whether a price move is truly backed by the broader market, which is especially important when making decisions in rapidly changing conditions. Now let us talk about volume-weighted average price, also known as volume-weighted average price. This indicator shows you the average price of a stock, but it is weighted by how much volume is traded at different times throughout the day. Day traders really like using this because it gives an accurate picture of the average price based on both price movements and how much volume is backing those movements. If the price is above the volume-weighted average price, it suggests the market is showing strength, and there may be buying opportunities as it indicates the price is being supported by significant trading activity. On the other hand, if the price is below the volume-weighted average price, it signals weakness, and there could be opportunities to sell as the price may be under pressure. The volume-weighted average price is also useful because it often acts as a dynamic support or resistance level, meaning it is a key point where the price has trouble moving above or below. Traders often look to volume-weighted average price as a guide to understand when to enter or exit trades, especially during pullbacks or consolidations. By paying attention to how price behaves around the volume-weighted average price, you can better time your trades and make decisions with more confidence. Another important aspect to consider when using the volume-weighted average price is how it interacts with different chart patterns. For example, when you see a cup and handle pattern forming, the volume-weighted average price can provide additional confirmation for potential breakouts. If the price is moving above the volume-weighted average price while completing the handle portion of the pattern, it indicates that buyers are gaining strength and could support a strong breakout. Similarly, in patterns like double tops or double bottoms, the volume-weighted average price can help traders confirm the validity of these levels. If a double bottom forms and the price crosses above the volume-weighted average price, it may signal a stronger bullish reversal backed by sufficient volume. Another key use of the volume-weighted average price is in conjunction with flags and pennants. When a flag or pennant pattern is forming, it is often a sign that the market is taking a brief pause before continuing in the previous direction. During this pause, observing how the price interacts with the volume-weighted average price can provide significant insights. If the price remains above the volume-weighted average price during the formation of the flag or pennant, it suggests that the underlying trend remains strong and the breakout may be reliable. Conversely, if the price falls below the volume-weighted average price during the consolidation, it could signal weakness and an increased risk of a failed breakout. The volume-weighted average price also works well with triangle patterns, including ascending, descending, and symmetrical triangles. In an ascending triangle, if the price remains above the volume-weighted average price as it tests the resistance line, it indicates that buyers are in control and a breakout is more likely to succeed. In a descending triangle, if the price fails to stay above the volume-weighted average price, it suggests that sellers have the upper hand and that the downward breakout is likely to continue. Symmetrical triangles can break out in either direction, so the volume-weighted average price can be particularly helpful in gauging which side of the market is stronger. By integrating the volume-weighted average price into your analysis of chart patterns, you can gain a much deeper understanding of the market context and improve your timing for entries and exits. It helps you assess whether price moves are supported by sufficient volume and gives you a clearer picture of overall market sentiment. This makes the volume-weighted average price not only a tool for understanding average price levels, but also a key part of a comprehensive strategy for trading chart patterns. Now let us expand on some common chart patterns that work well with these volume indicators. Chart patterns are a key part of technical analysis and can help you make sense of price action. When combined with volume indicators, they become even more powerful because you can confirm whether a pattern is supported by strong buying or selling activity. Let us start with a popular pattern called the head and shoulders. This pattern forms when the price creates a peak, followed by a higher peak, the head, and then another lower peak, the other shoulder. This can signal that a reversal is coming. When you see a head and shoulders pattern, you can use volume indicators like on balance volume or relative volume to see if there is strong volume supporting the reversal. If volume decreases during the formation of the second shoulder, it suggests the trend may be losing momentum and a reversal could be imminent. Another useful pattern is the double top or double bottom. The double top forms when the price hits a certain level twice and cannot break above it. This often signals that the price will reverse and go down. The double bottom is the opposite, where the price hits a certain level twice but cannot break below it, signaling that the price may reverse and go up. Volume indicators can help confirm these patterns. For a double top, if volume is decreasing as the price attempts to rise a second time, it suggests the move is weak and may fail, leading to a reversal. For a double bottom, if volume picks up as the price starts to rise again after the second bottom, it is a good sign that buyers are stepping in and the reversal may be strong. Flags and pennants are continuation patterns that often occur after a strong price move. A flag looks like a small rectangle, while a pennant looks like a small triangle. These patterns show that the market is taking a pause before continuing in the same direction. To confirm if the breakout from a flag or pennant is strong, you can look at indicators like relative volume or the volume oscillator. A breakout with high volume is much more likely to continue, while a breakout with low volume could be a false move. Triangles are another common pattern that traders use. There are three types of triangles: ascending, descending, and symmetrical. An ascending triangle has a flat top and rising bottom, suggesting buyers are getting stronger. A descending triangle has a flat bottom and a falling top, suggesting sellers are gaining control. A symmetrical triangle has converging trend lines showing that the market is in a state of consolidation and could break out in either direction. Volume is key in confirming triangle breakouts. When the price breaks out of a triangle, you want to see an increase in volume to confirm the move. If the volume is weak, it may mean the breakout will not hold, and the price could move back into the triangle. Lastly, let us discuss the cup and handle pattern. This pattern looks like a rounded bottom followed by a smaller consolidation that resembles a handle. It often signals a continuation of the previous trend. When you see a cup and handle pattern, it is important to watch the volume. Ideally, volume should decrease during the formation of the cup and then pick up again during the handle and the breakout. This shows that the selling pressure has decreased and buyers are stepping in, which increases the chances of a successful breakout. By combining these chart patterns with volume indicators, you can get a clearer picture of what is happening in the market and make more informed trading decisions. Chart patterns provide a visual representation of price action, while volume indicators confirm whether that price action is being supported by enough activity. This combination can significantly improve your accuracy when trading intraday. Another useful tool is called the accumulation and distribution line. This is an indicator that uses both the price and the volume to see if people are buying or selling a stock. The accumulation and distribution line is useful in intraday trading because it can help you spot times when the price and the volume do not match up. That is called divergence. If the price is going up but the accumulation and distribution line is going down, it may mean the price move does not have enough strength behind it and the price could reverse. That is why it is so helpful for seeing reversals before they happen. Now let us move to something called the volume profile. This one is different from the other volume indicators because it shows you how much volume was traded at different price levels instead of over time. This helps you see where the most trading has happened, and these areas often become key points of support or resistance. In intraday trading, you can look at the volume profile and find places where a lot of trading happened. These high volume areas can act as strong points where the price could stop and change direction. On the other hand, places with little volume mean the price may move quickly through those levels, and that can show you where a breakout might happen. Another important volume tool is called relative volume. Relative volume measures the current volume compared to how much volume is usually traded during the same time. This helps you see if the volume is above or below normal, which is a key indicator of whether a stock is experiencing unusual activity. This is important because if the volume is significantly higher than normal, it often means there is a lot of attention on that stock, and this can lead to big price moves either up or down. You can use relative volume to confirm breakouts and to determine if price movements are supported by enough trading activity. For instance, during a breakout, high relative volume is a strong confirmation that the price move is backed by real interest from traders. Conversely, if relative volume is low, it might mean the breakout lacks the necessary strength to continue. High relative volume usually indicates that something significant is happening with the stock, such as news events or increased market interest, so it is crucial to pay close attention during these moments. By observing relative volume, you can avoid false breakouts and position yourself for high probability trades. Relative volume is also very helpful when analyzing various chart patterns to understand whether the price action is likely to result in a continuation or a reversal. Let us consider the head and shoulders pattern as an example. When the head and shoulders forms, you want to observe relative volume to see if the volume is declining during the formation of the second shoulder. If the relative volume is low during this phase, it suggests that the buying pressure is weakening, increasing the chances of a reversal. This confirmation can give traders more confidence in predicting a bearish move. For patterns like double tops and double bottoms, relative volume can provide additional insights into the strength of the trend. If relative volume is low as the price attempts to form the second peak in a double top, it is a signal that the move lacks conviction and a bearish reversal is more likely. In the case of a double bottom, if relative volume starts to rise as the price moves up after hitting the second bottom, it indicates that buying interest is gaining momentum, which can confirm a bullish reversal. Flags and pennants are popular continuation patterns, and relative volume plays a key role in validating the breakout. If you see a flag or pennant forming, you should closely monitor relative volume during the breakout phase. A sharp increase in relative volume is a good indication that the market participants are backing the breakout, making it more likely that the price will continue in the direction of the previous trend. On the other hand, if relative volume is weak during the breakout, the move may not have the necessary strength and could fail. Triangles, including ascending, descending, and symmetrical triangles, can also be effectively analyzed using relative volume. When the price approaches the point of breakout in any of these triangle patterns, relative volume becomes crucial in determining whether the move will succeed. For an ascending triangle, if relative volume rises as the price breaks above the resistance level, it shows that buyers are actively pushing the price higher, increasing the likelihood of a sustained breakout. Similarly, in a descending triangle, rising relative volume during a downward breakout indicates strong selling pressure and supports the continuation of the downtrend. In symmetrical triangles, an increase in relative volume at the breakout point helps confirm whether the move is backed by market participation, regardless of the direction. Finally, the cup and handle pattern is another scenario where relative volume can be highly informative. During the formation of the handle, the volume often decreases, indicating a period of consolidation. However, when the price starts to break out from the handle, an increase in relative volume is essential to confirm that the breakout is supported by significant buying interest. This increase in volume suggests that market participants are accumulating shares, making the breakout more likely to succeed. By incorporating relative volume into your analysis of these common chart patterns, you can gain valuable insights into the strength behind price movements. It helps you determine whether breakouts, continuations, or reversals are likely to be successful, thereby allowing you to make more informed trading decisions and improving your overall accuracy in intraday trading. Now let us look at another indicator called check-in money flow. Check-in money flow measures the flow of money into or out of a stock over time. It uses both the price and the volume to show if more money is coming into the stock or if more money is leaving. In intraday trading, this helps confirm if price moves are really backed by enough buying or selling. For example, if the check-in money flow line is rising when the price is also moving up, it means there is buying pressure supporting the move and the uptrend may be strong. If the line is falling, it shows selling pressure and helps confirm downtrends. The last volume indicator we are going to discuss today is called the volume oscillator. The volume oscillator shows the difference between two moving averages of volume. One moving average looks at the short-term volume, and the other looks at the longer-term volume. The volume oscillator is great for spotting when momentum is shifting. When the short-term volume is much stronger than the long-term volume, the volume oscillator will spike up. This tells you that momentum is picking up and you may be seeing a strong price move. Positive volume oscillator readings can confirm that there is momentum behind a price move, while negative readings suggest that momentum is getting weaker and a reversal might happen soon. Now that we have discussed these different volume indicators, how can you combine them to be more effective in your trading? One simple way is to use the volume weighted average price together with on-balance volume. The volume weighted average price helps you find key levels for buying or selling, while on balance volume tells you if there is enough volume to support that price move. This can give you more confidence when you enter a trade. Another effective combination is to use the volume profile along with relative volume. Volume profile can help you identify key support and resistance levels based on where a lot of trading activity has taken place, making it easier to understand significant price levels. After identifying these levels, you can use relative volume to determine if there is unusually high trading activity compared to normal, indicating the possibility of a breakout or significant price movement. If relative volume is high near a key level, it may be a good time to consider a trade. Another powerful combination involves pairing check in money flow with the accumulation and distribution line. Check in money flow measures the flow of money into or out of a stock and helps confirm whether buying or selling pressure is strong. Meanwhile, the accumulation and distribution line helps you spot divergence between price and volume, providing an early signal that a trend might be reversing. By using these two together, you can more accurately gauge market sentiment and identify possible trend changes. You can also use chart patterns along with volume indicators for better trade confirmation. For example, when you see a head and shoulders pattern forming, you can use on-balance volume or relative volume to confirm if the potential reversal is supported by strong volume. This can help ensure that the pattern is more likely to result in a significant price change. Similarly, during continuation, patterns like flags or pennants, high relative volume during the breakout can confirm that the move is backed by enough interest to sustain it. In addition, using triangles in combination with the volume oscillator can provide excellent trade signals. For instance, if you spot a symmetrical triangle forming, you want to see an increase in the volume oscillator as the price breaks out of the triangle to confirm that momentum is picking up. This helps you avoid false breakouts and identify stronger trading opportunities. Finally, the cup and handle pattern, when paired with indicators like the volume profile, can provide a clear view of accumulation before a breakout. If the volume profile shows increased activity near the cup's low point and volume spikes during the handle formation, it indicates that the price has strong backing from buyers. This combination can give you the confidence to enter the trade as the price moves out of the handle and continues the uptrend. Even though these volume indicators are very helpful, there are some common mistakes that traders often make. One mistake is ignoring the volume when you see a big price move. If there is a price breakout, but there is not much volume behind it, the move is less likely to continue, so always check the volume before making any decisions. Another mistake is overreacting to a small spike in volume. Just because there is a small increase in volume does not always mean there is a big move coming. You want to look for confirmation from other indicators before making a trade, and do not rely on volume alone. Volume indicators should be used with other tools like trend lines and moving averages to help give you a full picture of the market. To sum everything up, the best volume indicators for intraday trading include on balance volume, volume weighted average price, the accumulation and distribution line, volume profile, relative volume, check-in money flow, and the volume oscillator. Each of these tools offers a unique perspective on volume and helps to confirm price moves, providing you with greater confidence in your trades. Let us also not forget about the importance of recognizing and utilizing chart patterns. Chart patterns such as head and shoulders, double tops, double bottoms, flags, pennants, triangles, and the cup and handle can be very effective in predicting future price moves. By combining these chart patterns with volume indicators, you can get a more complete picture of market activity. For example, during a head and shoulders pattern, declining volume in the second shoulder often signals a potential reversal. In double tops and bottoms, volume can confirm the weakness or strength of a trend. High volume at key levels of these patterns typically validates the potential for a reversal. Flags and pennants are powerful continuation signals, and it is important to see a surge in volume during breakouts from these patterns to confirm that the market will continue in the previous direction. Similarly, when using triangles, always watch for increased volume during the breakout phase to ensure that momentum is supporting the price movement. The cup and handle pattern is particularly useful when there is clear evidence of increased volume during the breakout from the handle, signaling that buyers are supporting the price increase. Using chart patterns in combination with volume indicators will help you confirm trends, breakouts, and reversals, thus improving your ability to make informed decisions. Try them out on your intraday charts and practice recognizing these patterns as they form. Practice combining these volume tools and chart patterns to confirm the overall market direction and adjust them to fit your trading style and time frame. Over time, you will become more comfortable and adept at using these powerful tools together for consistent and successful trading. Volume indicators can really give you an edge in your trading, but they take time to get comfortable with. Keep practicing with these tools, and over time, you will start to see more high probability trades. If you have any questions about these indicators, or if there are other topics you want to learn about, make sure to share your thoughts and keep the conversation going. Remember, the more you learn and practice, the more confident you will become in your trading journey.